Check, testing 1, 2.
It's a scary meeting afterwards. Okay, good morning, folks. I think we should begin, even though I think as a result of the rain, there are probably fewer people than had registered. We had about 100 people, I think, who'd registered. Developed countries, so it's a much more inclusive set of countries. But no matter how it's defined, the reality is that Asia is and has become a driving force in the world economy. And when I used to be at the World Bank, we used to always look at the impact of advanced country developments on Asia. And indeed, that continues to be true because of unprecedented monetary policies in the advanced countries, as well as faltering economies in Europe and a somewhat hesitant recovery in the United States. But now, what happens in Asia is of huge importance for the rest of the world. As we've seen in China, the exchange rate depreciation, the stock market correction had implications that had global repercussions. And so we have to keep a very close eye on what's happening in Asia, simply to understand the interaction now between nation economies and the advanced economies. Now, China, I think, is of particular fascination. As it happens, Carnegie had a session yesterday on China, and on Friday we're going to have another session on Asia as a whole as well, but a more wide-ranging discussion about the geopolitical aspects of the Asian economies. But what happens in China is of particular fascination as it tries to engineer a soft landing while reforming the economy to a more sustainable growth path. It's like trying to repair an aircraft in mid-flight. And given the opacity of the Chinese economy, given the fact it's so opaque, and the decision-making process is also so opaque, there are widely differing views on China. And you have the entire range of views from the highly optimistic to the very pessimistic. And it'll be interesting to see how our two speakers today come out on the Chinese economy. The issue of Abenomics in Japan, and whether the recent passage of the TPP, the recent successful negotiation of TPP will provide some external disciplinary pressure on Japan, and whether that will push Japan to introduce structural reforms in the domestic economy. So to look at all these issues and more, we have two outstanding speakers. We have, of course, Chang-Yong Ri, who is the director of the Asia and Pacific Department of the IMF, who will be giving the main presentation. Chang-Yong was the chief economist of the ADB before joining the IMF, and I've known him for many years. In fact, we've worked together on Myanmar, and I've learned to appreciate his insights and his very pragmatic understanding of what's happening in the Asian economies. And we have Uri Dadush from the Carnegie Endowment for International Peace. Uri has been a long-standing analyst and observer of global economics. He and I worked together in the early 1990s when we started the Global Economic Prospects series of the World Bank. And I've also learned to appreciate his command over issues related to the global economy. So we'll have Chang-Yong go first. He'll give his presentation. Then we'll have Uri provide some short remarks on the presentation. I may ask them a few questions after that, and then we'll open it up to the audience for a Q&A. Chang-Yong.
Thanks very much.
Thanks very much. It's my great honor and pleasure to be in Carnegie Endowment for International Peace, and Vikram to have a very generous introduction. This PowerPoint is based on our regional economic outlook, which was prepared actually before our annual meeting, which just ended a week ago. So maybe a little bit outdated and maybe a little bit long. So let me just go over quickly and then probably add a few more new things which I learned during our annual meeting at Lima. Can I move down? It's not going down. Relatively to many commodity exporters. An Asia slowdown has to be seen as a part of this global transition. And what surprised us actually is China's slowdown has been expected, but what surprised us more is its spillover from China's rebalancing to Asia and to the rest of the world. And I will explain later, the spillovers that we have seen so far is much larger than our econometric studies suggest before. And overall, even though Asia still remains as an engine of growth, vulnerabilities in many Asian economies are rising, especially for those countries which accumulated lots of private debt after the global financial crisis. Let me explain it in more detail later. This chart shows that our revised growth forecast for Asia region for 2015 and 2016, we expect that Asia will grow by 5.4% both in 2015 and 2016. And as you can see, 5.4% is lower than last year, but still the Asia's average growth rate is 2 to 4% higher than growth rate in the other region. So Asia remains as a growth pole of the global economy yet. But this average growth rate in Asia masks quite heterogeneous performance across the countries within the region. And let me first say that we maintain our growth forecast for China as 6.8% in 2015 and 6.3% in 2016. That was our April forecast. And despite the recent statistics, which show some significant slowdown in the manufacturing sector and the quarterly gross export-import numbers, we maintain our growth forecast at 6.8 and 6.3. Given the huge debate surrounding the China's growth forecast, you may be kind of curious why IMF may explain the details later, a little bit later. But if you look at the other region, you can see that even though we maintained our growth forecast in South Asia, India and South Asia, relatively we maintain stable. But you can see there is a huge the growth forecast revision downward in many parts of the other Asian countries. For example, East Asian countries like Korea, Taipei province of China, the growth forecast was revised downward by 0.9%, almost 1%. And you can see ASEAN growth forecast was also quite significantly revised downward. And many commodity exporters such as New Zealand and Australia and those countries also growth rate has been significantly revised downward. So in average, we didn't revise down Asia's growth rate very much because China is a big portion. But you can see that there are several Asian countries which has very close ties with China. Their growth rate has been revised quite significantly. So Asia is quite heterogeneous at this moment. What factors are behind this slowdown in Asia? Basically, is definitely China's slowdown, which I will explain a little bit more detail, and the U.S. lift-off and the possibility of capital outflows, and then commodity price decline, which I just mentioned. And also there are several idiosyncratic factors in many Asian economies, such as political uncertainties in Thailand and Malaysia, all these idiosyncratic issues. But today, I want to highlight in my presentation the first two factors, China's slowdown and the possibility of the capital outflows after the U.S. lift-off. Okay? So let me first explain then why we maintain our China's growth forecast. Let me save some time because this slide has so many slides, so let me just summarize why we maintained our growth forecast. First of all, I think this is kind of some sense self-promoting, but we have to say that the IMF forecast in April and last year was a little bit ahead of the curve. Our growth forecast 6.8 2015 and 6.3 2016 was relatively a low end of the market forecast compared with other leading institutions. And the reason is that basically we forecast our numbers based on the desirable policy that we are recommending to China. We are recommending to China that the credit-led growth, investment-led growth in the last couple of years, especially after the global financial crisis, is not sustainable in the long term. So we recommend them to rein in credit growth and slow down their economy. So 6.8 and 6.3 was already incorporate the possibility of their credit, the less credit expansion. And then in July and August, you know that the import and export figures were quite negative, and their, the high frequency statistics about their hardcore industries, manufacturing especially, shows a dramatic, cooling down in the second half of this year. But if you just focus on the growth rate in 2015, in the first half, China's growth rate was 7. China's maybe close to 7 and maybe above our 6.8%. But that is very short term, right? What we are more interested in is what is a kind of current trend indicate for the year, next year, and the year forward. And many people are shocked by the number, like a 7 or 8%, -7 and -8% of slowdown of import and export to China in July and August. But those numbers are nominal figures. If you look at the real numbers, and still the real import is in like a 2%, plus 2% rather than -8, 7, and 8%. So most of the nominal decline of the export and import numbers reflect lower commodity prices and lower manufacturing price, goods prices. So it's price effect. And if you look at the volume, actually volume is, yes, definitely slowing down, but it's not as drastic as many people seen in the nominal figures. And especially if you look at the China's import, even value terms, you see that the goods import are really going down fast. But you can see that still the nominal value of import of services is quite high. That actually is consistent with our view that there is a significant rebalancing is happening in China. Yes, they have overcapacity problem in traditional industrial sector. All the data like electricity use and cement demand, all these hardcore numbers for which relate to the manufacturing sector is really going faster than we expected. But on the other hand, consumption growth rate and service sector growth rate is still very high numbers. Like service sector growth is close to 10%. And so in some sense, we see the two different trends. Traditional manufacturing sector is cooling down. On the other hand, new sectors, services, and consumption still remains as robust. So that, given the import elasticity is much higher in manufacturing sector, that can explain why the export, import, trade sectors are slowing down too. So overall, I think we believe that China's data has been weak, but there is some evidence of rebalancing, and that actually is the main reason why the growth rate remains well above 6%, even though manufacturing sector is slowing down. And we believe this trend can continue, together with some weak stimulus from the government. And so the other pessimism and the other some concern on China's economy is their financial market. And that recently in China's stock market experienced a significant adjustment, and then exchange rate after the August 10 new system is introduced, and then China's exchange rate depreciate by 3%. But but you have to remember that China's stock prices has increased more than 100% in last 1 year before the correction in August. And then also exchange rate has, in real terms, appreciated more than 15% before it depreciated by 3%. So in general, we can think about this, the financial market, the turmoil, mini turmoil in last summer is a kind of adjustment of the, fast, the stock prices, bubbles probably in China and before. And definitely it caused some concern because people are now start to worry about whether Chinese authorities can control the market as many people has believed. And now it gives two lessons. One is that second, now China's market is no longer segmented. We think that, okay, in trade sector, China is well integrated to the global economy. We all know it. But we always thought that China's financial market is more excluded and more segmented from the international financial market. But the reality, we see that we see large spillovers from China's stock market adjustment and FX market. So no longer China is independent from the international market. There are two important lessons. But I think we have to see what happened in China during the summertime is maybe this is an indication of their process of learning by doing. And China will probably learn from these many experiences and may adjust to the new reality that I just explained. But what surprised us, as I mentioned, is spillovers. And this chart shows that at the time of the stock market correction and the time of the FX depreciation, the impact to many Asian economies was much larger than we expected. And let me just skip the slide. And this shows that on the day of August 10, when China's exchange rate adjusted, many Asian economies' exchange rate also depreciate together. And then even after August 10, the depreciation trend continues. But on the other hand, I think you have to also shouldn't think that many Asians' exchange rate adjustment is purely due to China, because there's a quite different the growth, exchange rate movement trend in Asia. If you look at the Hong Kong, Vietnam, and some frontier economies, the exchange rate has been tied to dollars, and then when dollar appreciated, their exchange rate has appreciated together quite a lot. So when they probably needed some adjustment given the weak growth trend and China's slowdown, all these things. So they also was at the time need to adjust the exchange rate too. And at the same time, like Australia, New Zealand, and Malaysia and Indonesia, who are commodity exporters, and together with the lower the commodity prices, some depreciation of their currencies is warranted and should be welcome as a kind of adjustment to new terms of trade, and the exchange rate depreciation can act as a sharp observer. So we shouldn't just say that, okay, all Asian currencies depreciate after China's currencies depreciate is all due to China. That view seems to be a little bit too naive, and we have to also think about exchange rate dynamics within the region. And then previously, I think when we actually estimate our growth forecast for many other Asian economies, we consider the slowdown, expected slowdown of China's growth rate, because we are assuming that China's growth will go down from 7.3% in 2000. So our econometric studies suggest that if China's growth rate slow down by 1%, its impact to neighboring Asian countries is around 0.3%. So if you just use the rule of thumb, if you assume that China's growth rate will slow down from 7.3 to 6.8, it's around 0.5. And then if you apply by 0.3, so its impact on other Asian countries can be like 0.2%. That was a kind of rule of thumb we had in China. Previous slide, the slowdown of East Asia, slowdown of many ASEAN economies in many other countries, except India and South Asia, which doesn't have that much close ties with China. The growth rate slowdown is well over 0.5%, and even for East Asian countries is close to 1%. So what we are observing is actually the spillovers is much larger than our econometric study suggests. Maybe I can say that the 2 to 3 times larger than what I surprised me. Because for fund size, we already say that the China's rebalancing is good for China for more sustainable paths, and good for the whole world because it's going to China become more safe, and they can rely on the consumption-led growth that's good for many other economies around surrounding China. But what's happening at this moment seems like China's rebalancing seems to have, in the short term at least, has a more some unexpected negative impact for several Asian economies. Why so is a question. I think it's unfair to say it's all due to China, because first, definitely, China's trade tie with its neighboring countries has become much larger. Through the supply chain, China now has, this chart shows how domestic value added embodied in export to China. You can see between 1995 and 2011, the China's trade and the value added creation in many Asian economies much larger. So definitely supply chain relationship tightened. So that is one reason for this larger spillovers. But the slowdown of many Asian economies is also affected by the possibility of the Fed lift off and the capital outflows. And so far, we see that the FDI flow to Asia remains quite stable. So we don't see that the FDI is now, we don't see much change in FDIs, even despite the many talks about Fed lift off. But on the other hand, portfolio flows show some sign of the outflows already. And we actually compare the amount of the bond markets, and we compare it from the period of immediately after QE tapering period a couple of years ago. And you can see that already the accumulated amount of capital outflow from the equity market in Asia, excluding China and Japan, is larger than those compared with the cases before, immediately after the QE tapering, as the right side panel shows. But on the other hand, if you look at the bond market, still we do not see that significant outflow from the bonds. So I don't know if the U.S. actually increase interest rate, this trend may continue, and then the bond market outflow may accelerate. But even at this moment, I think we are worried about capital outflows, but we have a mixed signal. Okay, from the equity market, there is already significant amount of capital outflow from the equity market in Asia. But on the other hand, bond market and FDI market seems to be stable yet. So we have to look at what's going to happen in the future. And I skip. So basically, if I conclude, I know previous to China, they say that their export of agricultural goods, the growth rate remained quite stable. And Vietnam, which actually sends which has a more close tie to Europe and the U.S. rather than China directly, and then also they supply some of the intermediate goods, especially the cellular phone or other things. They say their growth, export growth to China still remain high. So you can see, depending on which are with China, whether the U.S. actually selling more consumption good or intermediate good, even though it's intermediate good, where you are located in supply chain, the impact seems to be quite diverse. It's very hard to say that everyone is losing or everyone is gaining. So that was a kind of interesting observation. Okay, so far it's about the China. So I want to say three. One is that China is slowing down, but we believe this is already expected slowdown, and we are not. We don't see that the hard landing is likely scenario, even though the transition path is bumpy in the short term. So because they have some policy rooms, and also the service and consumption sector is growing. But on the other hand, in the medium term, whether the Chinas will have a soft landing in the I think I'm okay. After the global financial crisis, in the West and the advanced economies, fiscal consolidation happens, and immediately after the European and U.S. Financial crisis, public debt increased quite significantly, and many private sectors actually do the consolidation. On the other hand, many Asian economies, including China, after the global financial crisis, to maintain high growth rate, they rely on the credit expansion, and the private sector leverage increased quite significantly, including corporate leverages. And you can see that China is one great example, and ASEAN is not an exception. The private sector leverage has quite significantly increased. And then some people say that, this increasing leverage is a sign of the financial market deepening, and it's a desirable phenomena, because Asia need to further develop financial market, because compared with the real sector, Asia's financial market is a little bit less developed. But even after control, the GDP level, this chart shows that there are several Asian countries whose household debt or corporate debt is much larger compared with, even after controlling their income levels, in some sense controlling for the financial market deepening. As you can see, China and Hong Kong has a very exceptionally high corporate debt problem, and the Thailand and the Malaysia and Korea and others have a high household debt problems, which is well known. And when we do the sum simulation, it's of the vulnerability, because a large share of the corporate debt is owned by the companies whose profit level is quite low. So when you calculate what percentage of the corporate debt is owned by the companies whose coverage ratio, interest coverage ratio, which means how much you can actually pay your interest payments through your earnings, if it's under the stress scenarios, and so with interest coverage ratio less than 1.5%, and then their portion is quite significant. For example, in case of China, if we assume that the 20% of their earnings will go down, and if the 30% increase in borrowing cost, then the portion of is in the long term in China, given these high leverages. What complicates the matters is that now, if you look at the different deleveraging process between the state-owned enterprises versus private corporations, we see some evidence that many private corporations in the last couple of years, they do the many deleveraging process already. But still, if you focus on the state-owned enterprises, the leverage remains still high. So this is a dilemma. If you want to deleverage this state-owned enterprise quickly, you have to sacrifice the growth rate. If you don't do it, then this leverage problem can be in the longer-term problem. So China has a very complicated and delicate choices. The corporate people who is worrying about hard landing. But on the other hand, there's other concern. If China is worrying about the slowdown of growth, if they really pump up the stimulus and rely on the credit expansion to maintain high growth rate, then they may actually aggravate or they cannot cure this leverage problem, which can cause a longer-term problem. So China at this moment is very important moments. They have to really, go on think about this deliberate choice between this, trade-off. Maintain the reasonable growth rate, but at the same time has to address this leverage problem so that to address the, financial stability in the long term. So that is a quite, daunting task, and we hope that China can manage this transition, which we call is manageable but bumpy. And for China, one good news is that their debt is mostly domestic debt. But there are several other countries whose debt is, they had some FX denominated debt. So for those countries which has accumulated a relatively large FX denominated debt, they probably have to pay attention for this issue too, to remain less non-vulnerable, in considering the possible financial tightening conditions in the future. But I do not want to say that, if you ask me, are you worried about another round of Asia financial crisis in 1997, given this leverage problem? My answer is no, because so far I just emphasized the leverage ratio, but at the same time, if you look at the other macro fundamentals such as current account and fiscal, deficit surplus and the amount of reserves they have, and especially the corporate leverage ratios and the large liabilities they have accumulated after the global financial crisis should remain as a priority, policy priorities. So we actually recommend them in the next couple of years. Maintaining some growth rate is important, but don't try. So
because I'm often chairing his events, and so he reciprocates. Again, thank you for the invitation, the opportunity to discuss this succinct and interesting IMF assessment on the prospects for the Asian Pacific region. I actually do not have significant disagreements with the analysis presented. I have quibbles here and there, but I'm going to resist them in the interest of time. The most important point to me, and the most important message in the report, is that the slowdown of growth in the region, which in any event is moderate in historical perspective, is part of a process that is likely to make growth more broadly based, more consistent with the underlying growth of productive capacity, and therefore more sustainable. To me, that is the most important message about Asia and as it affects the rest of the world. Of course, the slowdown is most marked and most worrying in China, which has become so important in the eyes of investors, so big and dynamic that it is now receiving the same attention that I remember the United States did when I started in this business 30 or more years ago. And that tells us how quickly the world is changing. Now, if China's slowdown was just the result of reorienting the economy towards consumption and away from investment and exports, clearly an overdue adjustment, we can discuss that too, for many reasons. If that was the only reason, then I would worry less. After all, we have a very high rate of investment. There's a lot of evidence that some of this investment is misallocated, quite small in terms of value added in the region, dependent on export to China. What is really happening as well is that this structural adjustment is coinciding with a major cyclical correction of the kind we know and hate, the bursting of a major construction and investment bubble, investment in heavy industry particularly with a big buildup of debt, especially in the case of China, of corporate debt. And on top of that, for various reasons, China is experiencing a huge appreciation of its real exchange rate. So people focus on the devaluation, but when you look at the graph, what's really happened in China is you've had a gigantic appreciation of the real exchange rate over the last many years. So you have the structural adjustment, you have the cyclical adjustment, you have the exchange rate appreciation, and this, of course, means that the long-term adjustment that China is undergoing is even more risky and painful than it needs to be. When long-term investors and households become accustomed to 10% growth, which they did over 30 years, this becomes part of their spending and business plans. And then 6% growth feels very much like a recession, okay? There are actually some similarities, you don't want to stretch them too much, between China going from 10 to 6 and the United States going from 2.5 to negative 1.5, okay? I was once in business. I know how important it is that things go according to plan, because you build according to plan, you invest according to plan. And so it isn't just the deceleration, it is the speed of the deceleration. And I think the fact that it took many players by surprise. So when I look at those numbers, I'm actually not surprised that there is quite a bit of pessimism out there. And when you talk to business people, some of them are really tearing their hair out. And they're not focusing on the 6% growth rate. They're focusing on the rate of change. And as we know, things are made somewhat worse. It doesn't help that Chinese policymakers, who are vitally concerned with their legitimacy for well-known reasons, are unaccustomed to managing a pronounced domestically induced business cycle and stock market correction. So they tend to overreact or react, and they're suffering some of those after effects. The cost became apparent much later. Still, all that being said, the broader European, the middle-income countries in the broader European sphere, and the low-income countries in Asia, Cambodia, Laos, Myanmar, so on and so forth, are doing much better than the low-income countries in Africa that are now seeing a significant slowdown, reflecting the commodity prices. And so peer for peer in the developing countries, you have this 2 to 4% growth differential between developing Asia and the rest of the developing countries, despite the sharp slowdown in China and the anemic performance of Japan. And this, to me, is a good illustration of the dictum that development is what countries do to themselves, not what others do to them. Good for we have multiple growth poles. We're no longer dependent on one. We're no longer, as in the 1950s, to take the extreme example, dependent on the United States, nor are we dependent on China. Today, we have at least 3 major poles or 4 major poles of economic activity that are reasonably independent of each other. United States, North America, Europe, Japan, actually are relatively other blocks from the rest of the world, but on the other hand has more policy instruments to act countercyclically. And so Asian countries that are export-oriented have some capacity to reorient their economies towards domestic demand because of their fundamentals, towards their regional partners next door, even when China is slowing down, or towards the United States and Europe, which are finally recovering. To the political resistance of unproductive activities, such as agriculture and mom-and-pop operations and services, the severity of countries in Asia, and the depressing effect on investor confidence of confidence is not so much reflected in yields or credit spreads, but reflected more in an expectation that at some point, they have to raise taxes, and that affects investor expectations. So Japan is a good example, in my view, of the impotence of monetary policy and even of exchange rate devaluation when confronted with deep market. The slowing of world trade is not due to peak trade or peak globalization or reshoring or withdrawal from global value chains, nor is it due to rampant and regions, most notably Europe, which rely disproportionately on international trade of final products, parts of machinery, and raw material. More recently, and this is important, it has spread to commodity exporters, many of them dependent on China. This obviously impedes trade further because many of these commodity exporters no longer have the revenues to buy stuff from different parts of the world. And that's basically the adjustment that we're witnessing. The slowdown in trade, however, and I think this is in your report as well, is also partly the result of the end of transition. The boom in world trade in the 1990s and early 2000s was in part the result of the incorporation into the market economy of China and many other countries. In a book that we recently published, Chiedo Ozakwe and I, on WTO accessions, we note that the accession countries to the WTO, 32 of them, more than doubled their share of world trade since the inception of the WTO. Actually, 127%, including China, the increase in market share, and excluding China, 40%. Now, that transition is largely done, okay? We're not going to take Russia and China and Vietnam into the global market economy. Again, we have largely done that. But this cannot be read, should not be read, the combination of cyclical and one-time historic shifts as the end of globalization. There are many reasons. I won't go into because I've gone on too long. Technological, in particular, and the rise of many low-income countries that are still becoming, they are part of the market economy, but they're having a disproportionate impact on international trade because of the rising middle class in these countries, etc. There are a number of factors that are at play that are going to make international trade and foreign direct investment. Taxi service can get globalized because of Uber Okay, what else? You know, what is it that doesn't get globalized? Okay, obviously this, the continuation of this process raises the stakes on Asian countries to improve their international competitiveness and to participate in trade agreements, good or bad. For me, is better than no trade agreement. Thank you.
Well, thank you very much. All right, so, I have a lot of questions, but I'm going to resist the temptation of asking them. Perhaps I'll interject because in the course of the discussion, we've only got 30 minutes left, so I want to open it up to the audience. I know we have some real heavy hitters in the audience, and I'm sure they'll ask some really good questions. Let me recognize you, then wait till you get the microphone, provide your name and your institutional affiliation. Remember that this event is being streamlined, so it's very important that the question is heard, and then we'll go from there. All right, there's somebody at the back.
Which states, the prospect of the U.S. Federal Reserve gradually raising interest rates points to an unprecedented adjustment in the global financial system. Unprecedented is a striking word. We've had 1987, we've had 1929, and if you look at the debt that we've just been discussing, not only in China and Japan, what does
Thank you. Okay, well, why don't you, I think what Chandran is saying is he doesn't recognize that statement, he's not sure, it doesn't come from his document. Can you tell us which document? Fair enough. Which document does it come from?
From an IMF document. This was issued during the Lehman.
Okay.
Yeah.
When it put up, it's the IMF Global Financial Stability.
Report. Yeah.
Yeah, sure, yeah. Can you repeat that sentence?
Okay, this is the sentence. This is the sentence. The prospect of the U.S. Federal Reserve gradually raising interest rates points to an unprecedented adjustment in the global financial system. The sentence goes on, but keep it short.
It's two specific questions for me to interpret. I don't know this is the official view, but if I think about, if I just stick to the sentences, especially its impact on the Asian economies, I think in terms of magnitude, the amount of the QE and the capital inflows and its impact during the QE period, and that impact was so large. At least from emerging markets perspective, sentence is that considering this magnitude, probably this is a kind of an unprecedented impact.
In fact, I would actually support that. I also haven't seen this statement before, but the reality is that there's such a large stock of liquidity out there as a result of QE from the United States, from Europe, and from Japan, that now any shift in interest rates represents a huge to the institution. So it represents a very large shift, and that makes it, I would suspect, unprecedented.
So maybe we have to say potentially unprecedented. Probably.
Right. So there's somebody here.
Thank you. I'm Jennifer Lee. I'm with Hong Kong Phoenix TV. I have a question about the hard landing and soft landing you mentioned in your speech. So you said in the short term, something is happening, and you think the slowdown is manageable. You mentioned in the speech. Also, you said that soft landing, if they can have a soft landing in the midterm, is still a question. So, what's the risk on your mind that they might face a hard landing in the midterm? Thank you.
I said it's unlikely. I won't say that it won't. So it's unlikely because I believe that first of all, if you think about 1 or 2 years. So, there are many policy rooms they can react. And also, there's some evidence that rebalancing in consumption and service sector is also growth rates remain robust. So, in the short term, because of that, I say it's unlikely to have a hard landing. But the main reason why I mentioned that still, if you have a medium-term perspective, the prospect down the road, it will be endogenously determined what kind of policy they will implement from now on. So that's the point. we have many policy rooms, but if they focus on maintaining a very high growth rate and rely on the previous way of maintaining the growth rate after the global financial crisis, which is basically credit expansion, then the leverage problem I mentioned will remain same or even become aggravated. That may cause us some more problems. That is very critical to determine the medium-term perspective.
But there is a further issue, Chang Yong, isn't there? If you, and you said that China is beginning to rein in credit expansion, and you said that that was a good thing, something that the IMF would say was an appropriate response. But if the underlying structure of credit continues to go to state enterprises and to relatively inefficient firms, and as if you notice in your leverage graph, the leverage of the private sector is declining, whereas the leverage of state enterprise is rising, that difference could continue. In other words, it's not just the amount of credit that's going in, it's the quality of the credit.
Exactly.
So what is happening to the quality of the credit in China? Is China really introducing reforms that will improve the quality of credit and the productivity of investment?
That is actually a question why people are focused on their state-owned enterprise reform. And then the issue that you raise is even though they rely on new investment, we are not saying that they really reduce the investment, across the board. The investment must be more on the new engine of growth and new industries and where the new demands come in, rather than maintaining the old, industries survive.
But do you have any confidence that this is going to happen?
That is a question. I think it depends on the, you cannot be some growth rate, and this adjustment has to be gradual. And, for example, this old industrial sector is concentrated in northeastern part of China. So it's not just for the economic issue, but also the regional development issue and political issue too. And if you remember that early 2000, when they have state-owned enterprise problems after the Asia financial crisis, but at that time, it was relatively, I wouldn't say easy, but relatively clear what to do, because at the time, the problem was mostly small SOE has a lots of problem of profitability. So the solution was at the time was something, because now this problem was large-scale SOEs, and there is a political incentive to make it survive. But if you make it,
Can you elaborate more?
maybe you can avoid the Asian financial crisis type of collapse. But on the other hand, you may have a danger of really going down, losing the loss of efficiency and really going down. The potential GDP rate can be quite low. So this is a bad scenario. Chinese authorities fully understand this problem. They are announcing many reform agenda. And so how they reform the state-owned enterprises, especially on things in so, but on the other hand, there are other problems can coming in. So this is a very delicate balance, and you have to, manage this both. Right? In some sense, smooth transition, but at the same time, focus on the quality, not to make your old industry just to survive. They need to contribute to moving resources from old industry to the new industry.
Peter?
Pure and the manufacturing financial market is much open, and they have more chance for the foreigners to take the capital out. I think the chance that capital outflow by foreigners is relatively limited at this moment in China, and that is why we think that they have a room to manage this slowdown compared with other countries.
Thanks. Uri?
Yeah, Peter, I don't have the numbers in my head. When I looked at the numbers, I was very impressed by, first of all, the size of the sector at the starting point. I don't remember the numbers, but much larger, for example, than Ireland and Spain.
60% of GDP.
Rising debt levels of the state-owned enterprises. This is all quasi-fiscal or fiscal, however it is done, or the encouragement on the state policy banks, on the policy banks to expand credit, et cetera, et cetera. These are all stimulative measures, however you want to describe them. And if they were not there, then we may not be seeing 6% or 6.5%. So you have to think of an economy that went in an autonomous way from 10% growth to somewhere near 4% growth or something like that before the government actually counterbalanced. And that tells you the massive effect this has had on companies and has had on individuals, on households, and is totally consistent with a crash GDP construction at the peak, okay? And at that time, we had 2 million housing starts. That was about 2006, okay? Today, 10 years later almost, housing starts are doing better. We are up at 1.1 million.
Think about two effects, right? I think already China's financial linkages with Asian economies is growing quite rapidly. If you go to the Cambodia, for example, you can see many operations of the Chinese bank in Cambodia. Yes, they rely very much on the dollar, but eventually when SDR becomes more, the renminbi become more SDR currency and internationalized more, the usage of there are lots of trade linkages. So it's even for the settlement currencies, it can be used. So once the renminbi use increased, then I think this financial channel, whether it's positive or negative spillovers from the Chinese economy on Asian financial market, we have to say it expected to grow. And then the other thing is that China has many bilateral swaps with many Asian economies already. And then if the renminbi become a SDR basket, in some sense, those renminbi denominated swaps can be regarded as a part of reserve. Then I think it can have an implication for the regional or global safety net. So it's hard to how fast it's going to happen, but renminbi inclusion in SDR basket can be a significant impact in Asian the dynamic. Whether it's going to be included or not, I want to make clear, whether they will be included or not will be decided by the board.
Yeah. There was a lady behind, yes.
Hi, I'm Carol Pan from Taipei Economic and Cultural Representative. And I have one point and one question for Mr. Reed. And my point is that Taiwan is now a province of China because Taiwan right now is governed by the government of the Republic of China, not the other China. So I hope that in the future presentation, Taiwan can be addressed more appropriately. And my question is that, do you think that TPP can reduce the spillover from China, can avoid the Asian country avoid the spillover effect or shocks from China's slow growth rate?
Thank you. In fact, that was an issue that we wanted to raise, the impact of the TPP, both on China's spillovers, but also how would it impact the region as a whole? We haven't talked about the TPP yet.
Before I go to I say Taiwan province of China. Did I make some mistake? I don't know.
No, sure.
Officially, I mentioned Taiwan province of China. So I understand this issue this is a sensitive issue. So I hope that I didn't make a mistake in saying the Taiwan province of China. But as for the TPP, I think this is related with Uri's point about why the global trade is going down. I think he actually has excellent presentation of the many reasons why global trade is going down. But in my opinion, another maybe the factor is that maybe in many FTAs and trade agreement, low-hanging fruits is already being taken. Now, unless we really raise the level of ambition, maybe the marginal impact of having one or two more trade negotiation, regional or global, maybe can be quite marginal. In that sense, I think TPP I have a very high expectation of TPP because TPP is the first trade negotiation within the region which discussed quite sensitive issues, such as the opening of service market, procurement, and the property right. And in some sense, those are the things which are very hard to Asian policymakers volunteer to address and solve by themselves. And having this TPP address this issue,
Yeah, on TPP, I like to say that it's like Coca-Cola. It's a great global brand, but you don't know what is in it, okay? And that's part of the problem in discussing TPP at the moment. So I agree that it goes into a number of new areas, etc. But until we know what is being said in these the negotiation on rules, yeah, whether it's state-owned enterprises, government procurement, investor-state dispute settlement, liberalization of services, what it says about investment. Until we can actually look at the details, it's very difficult to claim that we are breaking new grounds. There are many trade negotiations going on, including, by the way, the ones that are least noticed and that are often the most innovative in terms of new rules and new approaches are the accession negotiations in the WTO. I mean, China passed something like 3,000 domestic laws in consequence or related to its WTO accession protocols, and many of them, many of these protocols include what's called WTO plus, which are rules that go beyond or provisions that go beyond traditional WTO disciplines. So let me stress that what I said at the end of my talk, even a bad trade agreement is usually better than no trade agreement. So I'm happy that we have TPP, but two things. Before we sing victory about the rules, let's understand what is in it and how far they've really gone. I'm a little skeptical in that regard on most parts, but again, I'm operating on the basis of hearsay. And the second is, the second point to stress on TPP is that it actually will do very little new trade liberalization, despite the USTR line about the 18,000 taxes on U.S. exports. The people who have done the analysis conclude that the impact on welfare of TPP tariff liberalization is absolutely minimal for the vast majority of the parties, for the simple reason that trade is already largely free. I mean, the United States has trade agreements already with 6 of the 11 partners in the TPP. But it does seem that it will have a significant impact in Asia, and that is Vietnam and Malaysia. So it will have some impact there, but in the aggregate, in terms of new trade liberalization in the Pacific area, it really is at the margin for the vast majority of countries.
Well, you'll be put out of your misery soon, because the text is going to be released literally in a few days, probably next week. So we'll all take. Yeah. I'm afraid, Craig, we've got to stop because we've run out of time, and John Kerry is going to be speaking in this very same room in an hour's time, and we have to leave because there's got to be a security sweep, and there are security folks outside already. And I promised that we'd finish at 11:30, and that is my duty. So thank you all for coming, and please join me in thanking our 2 speakers for today. Thank you.
Well, when they put me out of my misery, I'll answer the question.